let's kick things off. Welcome everybody to today's fireside chat on user-first embedded finance and payments. For those of you dialing in from London, I know it's an absolute scorcher outside. So the fact that you're here with us today and not in a park outside somewhere is very much appreciated, and I think just is a testament to how interesting and dynamic this topic of embedded finance and payments is right now. Thank you also to our very special guest, Alex Mifsud, who joins us today. Can't wait to dive into the topic with you, Alex. Before we get into that, though, would you like to give a quick introduction to yourself and your sort of interest in the area?
Sure. Thanks for having me, Shona. Well, I'm Alex Mifsud. I'm co-founder and CEO at Weavr. Weavr is an embedded finance platform, but maybe explaining our mission is more telling. And our mission really is to make it easy for digital businesses to integrate financial features into their applications. But equally, it's also to make it safe for customers to access those financial services, when they're using these financial services in the context of those applications. And we've been running since 2021. We're very pleased to be backed by a number of global fintech-focused VCs, QED, Anthemis, Headline, Tiger Global, several others. They've made us able to really finance the building of the infrastructure that we rely on to make these things happen. We now focus almost entirely on B2B opportunities, and we're now very pleased to be serving a number of large global B2B SaaS brands, enabling them to embed financial services into their applications. So maybe that's a good context in which to start the rest of this.
Brilliant. I feel in very good company today and looking forward to getting stuck in. So in way of an agenda, we're going to split today's conversation down into three parts. So first of all, I'll be talking to Alex about what is embedded finance and why is it growing in popularity? What is it used for? Why is it important? We'll then be talking about how you can think about taking a more user-centric perspective as you design embedded finance or embedded payment solutions for the real world. And then lastly, we'll be looking ahead. So what's coming down the line in embedded finance or payments that you need to keep an eye on because they could disrupt the industry or have a significant impact on how these solutions need to be approached. We will have time for a Q&A at the very end, so do feel free to drop your questions into the Q&A chat, and we'll answer as many as we can, time permitting, in the last 10 minutes or so of today's session. So let's just get straight into it, and it's always good to start from the beginning. So Alex, what is embedded finance or embedded payments, and why is it growing and gaining traction in the payments and technology space right now?
Yes, let's start with something really foundational. None of us, whether we're acting as a consumer or whether we're acting for a business, none of us use financial services for their own sake. We don't get a loan because we like loans and we accumulate loans for their own sake. We might get a loan because we want to do something that will help us grow our business. So there's always another sort of objective to financial services. It's very much in their nature to be facilitators of something else that we're trying to do. At the same time, in a kind of different neck of the woods, there's all these digital applications helping us do exactly that same thing, but from the point of view of data, of automation. So if I'm getting a loan because I want to, increase the size of my headcount because I want to have more salespeople on board, but guess what? There's going to be some software out there that helps me recruit those salespeople, to train them, to organize them into a sales operation. And so in the end, you have these two worlds: financial services enabling you to do more, to do things maybe looking at being able to invest more in the future rather than just doing what you can afford right now. And then you've got the world of digital helping you do those same things in a way which takes advantage of data and automation and insights and really all the additional stuff that digital experience give us today in our lives. The problem is that often these two worlds sit apart, and when we're trying to get the job done, we're looking at moving from one side, from an application, and then stopping ourselves, going to the financial service provider, typically in a portal or a mobile app, and we're then continuing that activity in there, sometimes having to take data with us, sometimes having to take data back to the original digital application so we can continue doing the job. And that is highly unsatisfactory. So the whole point of embedded finance is very much to bring these two worlds together and to bring them so that we can get the whole job done without having to move back and forth these two different worlds of digital applications and the worlds of financial services.
Yeah.
So there's something very foundational in terms of the value of bringing these things together, and that is what is behind the traction that embedded finance is now seeing.
Absolutely. So it's important to think of that financial or that payment transaction really as an enabler to something else, right? It's not an end in and of itself.
Absolutely, and there are plenty of examples in this. I mean, I'll pick one that we're particularly familiar with. Take employee benefits. Take something like a benefit like mobility allowance, for example.
Mm-hmm.
Now, businesses might have policies for how they contribute to the cost of commuting and of their employees, but ultimately the execution of that has to do. You're going to enter the tube and you want to pay. You have to use something to get in, and that normally is a card. Now, in the old solution, you might have been using your own card, and then you file a claim, and the business will then make sure it fits the policy, and then they will reimburse you. That is a lot of work for everybody. It's a lot of work for you. You're fronting the cash. The company has then to collect the claim that you make, which you also have had to spend time doing it. They have to
Mm-hmm.
verify it. They have to then send the payment to you. That's much more complicated than being able to integrate in the way they run their policy for their mobility allowance into something where you can use the same app, you manage your leave, you book your leave in, and simply tap on the tube with that app, and that automatically pays out of your mobility allowance. And everything is all organized. The data is coming to the company in real time. It can check that it's adhering to the policy, maybe the time of the week, or that you've been allowed to use your allowance. It just makes things better for everybody. It just increases the quality of all this sort of the way that the particular problem is being solved. And just like this example, you can have it across many consumer applications. We all know the delight we felt when using something like Uber for the first time. But also in business applications, there are just so many opportunities, so many instances like this in accounts payable, in HR management, in project management, where bringing the financial element and the software element together just uplifts everything in terms of the experience, the efficiency, the increase in quality of controls across the board.
And it sounds like that sort of more cohesive and enjoyable experience is not only for the users or the sort of the people making that journey, but also for anyone else around that needs to kind of be doing any kind of back office support tasks, etc., to help kind of finalize that transaction on the back end as well.
Yeah, if I may generalize, the drivers for the business customer is there are really kind of four big drivers. One is the obvious one, increase in productivity. You spend less time, swiveling chairs from one application to another, basically. And this, there's been a study that chair swiveling between applications takes about 90 minutes per employee per week. So it adds up, right? But you also get improved controls and visibility on what money is being spent on, and you get that in real time. So that's a second big motivation. This third big motivation is reduction of errors. There's been a study by IBM that cut and paste errors in finance amount to around $3 trillion a year. I'm sure not all of those errors result in actual losses, but basically they can be quite consequential. By joining data up with financial activities, you can actually reduce the amount of errors massively. And the last one, perhaps a bit more sinister, is about protection against fraud, especially internal fraud. That, if you're kind of extracting data and then that data is uploaded into payment systems, that data could be manipulated. It's there's lots of control when you're doing these joint activities with lots of humans in the loop. So these are all areas which have which are real pain points for businesses that embedded finance can solve in a fairly comprehensive way.
Brilliant, brilliant. So there are multiple stakeholders that can benefit in different ways from the introduction of embedded payments and finance. We talked a little about the users themselves and the businesses that might be looking to invest in such solutions. And we'll dig into a little more into some of those case studies in just a moment. But this is such a topic that I think is being so widely talked about. I know a lot of the payments technology conferences I've been to, a big buzz around embedded finance and embedded payments. As a practitioner in the space and somebody who works is sort of like in the details of all of this, are there any sort of common myths or misconceptions you see about embedded finance and payments in the general discourse within the industry that you'd like to dispel?
Yeah, I'll pick a couple. My favorite one is that embedded finance is often sort of mixed up with or conflated with banking as a service. And this really needs to be unpicked, because banking as a service is one way of achieving embedded finance. There are different ways of doing it, and I think it is worth exploring those different ways of doing it. At Weavr, we have a kind of house view that banking as a service is one of, at least that's how it originally conceived, is one of the most expensive, and even sort of unsafe way of doing embedded finance, because the typical promise with banking service is that it allows the software company to build the financial product that they want. And if every software company builds a different financial product on the banking as a service platform, then the bank finds it very hard to provide proper oversight over all of those different financial products that are built by their customers. So what tends to happen is that banks lose control effectively of what is actually happening on their platform. And regulators have kind of cottoned onto this in the last few years, and it's given banking service a really bad rap. And now embedded finance doesn't have to be like that. There are now new breeds of solutions where the financial product itself is designed to be embedded. It's not, you're not asking the software company to build a financial product from scratch themselves, but actually it is the financial institution or a partner of the financial institution that's building the financial product, but designing it so that it can be easily embedded. So a solution might be an embedded lending solution, which is specifically designed so that accounting systems can start to offer it as part of their account receivable capability, so that you can turn your account receivables into cash by tapping into that solution. Solution is very specifically built for a purpose, and it's designed to be embedded into, say, accounts receivable software. So that's the alternative. That's very much embedded finance as well, but it doesn't have the vulnerabilities and the complexity of banking as a service. So conflating the two, I think, is quite dangerous. Embedded finance is a concept that achieving financial features within software. Banking as a service is one way to do it, but it's not the only way or even the best way to do it. So that's kind of my favorite myth, which I really want to kind of smash here.
Yeah. Any others?
Yeah, maybe this is also kind of an interesting one, which is that embedded finance is ideally suited to power fintechs, right? And in a way, fintechs are the least good fit with embedded finance. Usually, fintechs can use embedded finance or means of embedded finance like banking as a service to go to market faster. But what tends to happen is, because a fintech is making all of their money from the financial services ultimately, when they're successful, they tend to replace the banking as a service with their own licenses, with their own processing technology. And so they tend to be easy customers to convince, but they're not long-term customers if they're successful. Whereas if you're dealing with software businesses, they're never wanting to be fintechs, right? They're never wanting to be financial service providers. and they already have a business without the financial service. So again, the idea that embedded finance is something for fintechs is a real bad misconception. Embedded finance is for everybody else, actually, for all the digital businesses that can profitably add financial services features into their software, but don't necessarily depend on financial services to have a value proposition at all.
Yeah, again, seeing it more as like an enabler for something rather than, wanting to take on the risk and the regulatory burdens of becoming a financial institution in and of themselves.
Absolutely.
Yeah. Okay. Well, I'm gonna bear those in mind, and next time I'm at an industry event and they're talking along these lines, I will start heckling that they've got it all wrong, and I'll have a chat with them afterwards. All right then. So, in terms of then digging into some specific use cases, we touched a little bit about how there are consumer and there are commercial use cases for embedded finance, embedded payments. What do you see as being like the most exciting ones, both from the perspective of what you do at Weavr, but sort of more generally in the industry at the moment?
Yes, I mean, I have a slant towards B2B use cases. That's where I'm spending most of my time right now. So I see, for example, a big transition or evolution in for example, payroll type applications to start offering things like earned wage access. These are really impactful. A few years ago in the UK, there was a lot of scandal around payday loans and what they did to people. And payday loans were sort of great, better than loan sharks, of course, but they still made a lot of people miserable because they couldn't afford to pay them back. And earned wage access has a real benefit to the employees because they are tapping into money they have already earned. Maybe halfway through the month, they are owed 2 weeks' wages, right? Because they worked for half the month. And earned wage access solutions allows them to tap into that money without having to borrow it effectively. And so they have a lot of social good, and they are a very good fit with payroll software, as you can imagine, because that's where the data is sitting. So the combination of payroll capability and the accounting for how much work has been done, how much is owed to employees, with the ability for money to be released so that employees can tap into what they have already earned anytime during the month is, I think, a fantastic example where you have something which actually delivers a lot of value by bringing financial service together with software. So that's something we're seeing, as a growth area. It's a natural place for payroll software, for HR tech generally, to start introducing this. And at Weavr, we do power some of these. We provide the financial engines, if you like, that help with all the financial plumbing of collecting money from the employer at the time of payroll, extending the cash to the employee, and making sure everything is secure and has all the right consents at the right moment. So that's one example. There are plenty of examples. One which we've recently announced, so I can talk about it because it's public information, is Paperchase. Paperchase is a company that helps restaurant chains really manage a lot of their business processes, paying suppliers, organizing their stock and rosters and all the rest of it. And Paperchase, one of the challenges they've had is that whenever they need to make payments on behalf of the restaurant chains that they help support, they don't have access to their bank accounts. And
Right.
chasing after a very busy restaurant owner to try and go and approve the transactions and get everything done on time, whether that's paying the staff or paying suppliers, has been a real big pain point for them, as you can imagine. We have delivered an embedded finance solution, and that would allow them to typically set up a payment run, get it all ready for payment as a single, as a single approval, and for the restaurant owner in their own time, using a mobile app, being able to say, yes, I'm happy for that to go ahead, and it gets scheduled, it gets paid, and everything gets posted in all the right places. So that's also another example where I think the value of joining things up, the controls, the payments, the data, the workflow, just unlocks a ton of value that has real impact on ultimately on people's lives.
Absolutely. And I can see we've got a few AP, AR, automation, accounting software type folks on the line as well today. What do you see as the value for their benefit of embedded finance and embedded payments in that world as well?
Yes, I think accounts payable, if I had to pick that one, ultimately there are systems that are track which invoices are going to get paid, when they should be paid, maybe deciding which ones should get paid first because they're strategic suppliers or because they can get discounts. So there's a lot of kind of intelligence around deciding how to process invoices and when they should be paid. But ultimately, they need paying.
Hmm.
And sort of typically the people handling the data around accounts payable are not the same people who are necessarily handling treasury and who are actually executing the payments. So there is a real opportunity there to join them up, to be able to pass on the data and the requests and the controls in a way that where the payment execution can happen. And the data goes back the other way, because when payments happen, recording that the payment has been successful, obviously with the timestamp of when it happened, recording that back into the system avoids a lot of manual reconciliation after the event. So it is one of those examples where the joining up unlocks value. It does more than that though, because once you have all this stuff joined up, you can start to create opportunities. For instance, for how you source the cash for doing a payment run. You might find that because you have all this data within say the accounting platform, you know that the payer is able to tap into a line of credit to do their accounts payable. So you can offer them in a just-in-time way the ability to finance part or all of their accounts payable payment run, to be financed by a working capital loan or some sort of line of credit. So it creates really opportunities and hooks for adding more financial activity, and for the banks for selling more financial services, and for businesses to access more of these financial services that can really sort of help their business work better.
Yeah, that's a really good point. And I know from the work that we've done in the space in the last few years, we've seen a lot being done in the SMB space as well. For example, in this respect, where you have small or micro businesses that have cash flow issues and need to get paid faster. The embedding of payment links into invoices. So to smoothen out that journey of paying and being paid for those sort of more micro transactions that are happening on a day-to-day basis. So whether it's sort of like a more of a sort of treasury situation, large corporate, but right down to sole traders and micro businesses, I think we're definitely seeing a lot in terms of facilitating how businesses can get paid.
Absolutely. Removing friction, using data to make things happen faster, more accurate. These are the themes, right, that keep coming up.
Yeah, absolutely. Brilliant. Okay, so let's move on then. We've talked a lot about the benefit for users, for businesses, for even people making payments. What is the benefit or the value proposition of embedded payments in finance for the banks and the financial institutions themselves?
Well, it ought to be huge, right? Because we were talking about the accounts payable situation where you have the perfect opportunity to offer somebody a loan, right? So embedded finance is one of those kind of ideal points where the offer of a financial service can show up at the point when it's needed in all the context. So it is one of the most efficient sales channel you can imagine. You have all of the richness of the context of the need happening at that particular point in time, and the financial service just shows up saying, "You need me. Here's how you get me." So it is it is one of the highest conversion sales channel when you get it right. Once you've sold the service, delivering it is also super efficient. You don't need to build your own mobile app or your call center or branch or your relationship managers to actually deliver the financial service, because you're already embedded in the context of how it's going to be used. Delivering that financial service is actually super efficient. So the economics of embedded finance for banks are incredible. There is a trade-off, of course. Banks will forfeit their brand when they do that, because what the customer is experiencing isn't the whole journey that the bank curates effectively to build trust and to develop a relationship, that is happening instead with the software, right? That is ultimately making available that financial service. But I think for those banks who decide they really want to double down on being more of a wholesale provider of financial services, there is something very powerful about the embedded finance channel. And if you compare it to the channels that are available to banks, obviously the branches have long been considered to be relatively inefficient channels. You've got the web, you've got mobile, and then you've got embedded finance, which is a much more tailored, targeted, and very powerful sales and delivery channel. So those banks who want to do it, there is a really strong business case.
Yeah, and
There
that
are
really
obviously risks.
Yeah, and that really resonates with what I hear from clients and industry connections, where it's that concern about, the brand erosion, the relationship erosion, the fear of becoming almost like a back end commodity if it's the SaaS that owns that relationship. Do you feel like it's still, those risks still are outweighed by the benefits, or is it really just a wholesale play for those that maybe are not as concerned with those items?
Yes, what it does create, there are some banks that have already very strong established communities and brands within certain segments, but maybe they don't have great established brands in other segments. They might be great, serving corporates, but really poor at serving small businesses, for example. And embedded finance gives them an ability to play in a wider playing field by taking a segment where they're not particularly good at distribution and then tapping into embedded finance, strategically so that they can unlock segments that they're not particularly good at, where their brand isn't that well known. So it just gives options for banks to be, I guess, to really design their distribution and really design their economics around these trade-offs. They are real trade-offs. The less they are in front of the customer, the less they're engaging directly with the customer, the less they're likely to build their, that brand trust and recognition. But equally, it's a super efficient sales and delivery channel. So if they're not doing anything anyway in that segment of customers, it is certainly worth a look to develop as a distribution channel.
And to what extent, then, given those risks and trade-offs you just mentioned, to what extent do you feel like embedded finance and payments is being driven by financial institutions or financial services providers versus the SaaS players themselves who may be looking to do this more aggressively? What's your view on who's driving this?
Yes, I think general banks are behind the curve on this. I think there are other considerations. They tend to do more with the risk of actually participating in the embedded finance channel. I mean, security is clearly one of them, right? That the types of kind of security standards that general software companies, B2B software companies, are, are nowhere near the kind of security standards that banks hold themselves up to. So there's a misalignment there, and I think banks find it difficult to get comfortable with operating in that kind of environment. There are also compliance considerations. I think if you take some legislation such as consumer duty in the UK, when there's a lot of responsibility for banks to be responsible for good outcomes for customers, when they're working through an embedded finance channel, the bank is not off the hook. But at the same time, they have much less control over good outcomes for customers, right? And being able to promote their financial services in the right way. So there are real challenges, I think, for banks to get this right. The more onerous regulation is, the more they have to navigate what does this regulation mean in the context of this new channel called embedded finance. And there are some hard problems to solve there before banks can be fully comfortable that they can fully take advantage of this powerful channel.
And so for a financial services provider or a bank looking to get into this space, then what would be your sort of main advice of getting started and getting started in navigating the complexity of this?
Well, I think first you have to, the first stage is really understanding enough of the potential to decide that it's worth the investment. I think for those banks that see the investment and see within their strategy of distribution that this could really move the needle for them, then it's really about being honest about the challenges and looking for solutions. Often those solutions will require partnerships. Banks do not have the native skills and native technology to be able to navigate a lot of these new challenges with this channel. They have, they have built those skills on the web. They have built those skills on mobile. These are channels they control end to end. With embedded finance, they do not control the experience end to end. They're relying on a third-party software business that probably doesn't understand financial services and is certainly not building to the same standards that they're building. So they need to work with partners who have specifically focused on this problem. How do you do embedding of financial services in a way that upholds the standards of the financial institution and yet is seamlessly integrated into third-party software? And at Weavr, we have a bit of a checklist in terms of the kind of things we look for when answering that question. We have this acronym called DOACT, DOACT, and for example, D stands for data security. How do you make sure that the implementation at the software business is not compromising the data security of the bank, right? And there are a number of solutions to that, which typically are not one of the solutions that banks use today, and therefore, partnering is a good idea for banks. O stands for onboarding. If you are embedded in a software application, the software application does not want to tell the customer, please now go to your bank and go to the bank and get onboarded to get an account opened, and when you're ready, come back to continue your process. That onboarding should happen seamlessly within the software application, but it's a really hard problem to solve. Everyone knows how hard onboarding new customers is, right? With all the requirements for anti-money laundering, for a whole bunch of compliance requirements. I mentioned consumer duty. That's also another obligations. Generally, how you treat customers when you are serving them through an embedded context. How do you do transaction monitoring? How do you do authentication? Strong customer authentication is a legal requirement. How do you ensure that the software business, when they're obtaining consent, when a customer is approving a transaction to go ahead, is doing it to the standards that actually comply with the regulatory technical standards for strong customer authentication? So you can unpack this problem, but then you have to go and find solutions. And it's much more likely that specialists in embedded finance will have found solutions to these than you would expect banks to have already had in their own existing technology stack.
Yeah, brilliant. And what did the T stand for again in DOACT?
It is transaction monitoring. How do you do monitoring of transactions and other sort of user activity, within the context of another software application that you have no visibility and control over?
Yeah, brilliant. I like that acronym. It's short and sweet, but it's very memorable. So nice little trick of the trade there for anyone looking into getting into this space. All right then. So let's move on to our next section, Alex, which is really about how to design these embedded solutions for the real world. I know from the conversations we've been having, just how important taking that user-centric, customer-centric viewpoint is. So how can businesses, when they're looking to develop something, avoid the trap of not developing something that solves any real problem or any real friction point in the lives of their users and their customers?
Well, I mean, with any technology that becomes sort of hyped, right? You almost have product managers being told, go and do something in this space. Everyone's doing it. We need to do something as well. And often that leads to solutions that are not really solutions. They're just features that make the software look like it's been updated. I mean, the advice is very basic. Start with the problem you're solving, and the problem you're solving is not a financial services problem. It's a problem. It's not even a software problem you're solving. It's a problem that the customer has, and it's why the customer is using your software in the first place. And when you do that and you kind of work backwards, you start to ask the right questions to, what are the points of friction? How can I remove these points of friction? How can I take jobs to be done which are financial and jobs to be done which are non-financial, and how do I bring them together so that they together solve the whole of the problem rather than the fragmentation that we have at this point in time. I think it's also understanding the constraints and in the context. Often compliance gets in the way. You might want to, the solution might work really well on paper, but if you have to add an onboarding step, a financial onboarding step in the mix, that is going to disrupt the whole experience, and that might just not, the juice might not be worth the squeeze, right, at that point. And so I think you have to go with working backwards and keeping in mind the value to the customer against all of the additional burdens you're going to have to take on in making that solution happen. And sometimes there is no good solution. You know, a lot of regulation we work with today has, and a lot of technology has limitations. You know, open banking has a whole bunch of limitations. You can't open an account through open banking. At the same time, you know, we talked about all those challenges with authentication and with customer onboarding in an embedded context. When you put those together, if you cannot have a better outcome than not having a joined up financial service and software process, then don't do it. So I just think there is no magic solution that will always get you an answer. You just have to go work backwards from the problem you're solving and use the ingredients of embedded finance to try and find a solution. In many cases, you'll find a way, but in some cases, it is just not worth doing it.
Yes, it's sort of marrying up the problem that you're solving for and the value you're creating with the commercial or regulatory reality and feasibility of being able to do that, and then making sure that that is sort of cohesively being considered as you set out, I think. What do you think? I mean, we talked about the jobs to be done. I know you and I have talked about the jobs to be done framework, which is where you essentially start off by defining the jobs that need to take place and you know the pain points that arise. We've talked a lot about functional jobs that might need to get done across that workflow. What about sort of emotional jobs or the social jobs and you know the kind of the context of the person and the reality that they're experiencing beyond just the functionality, but also sort of what it means for them in their day-to-day experience?
I think that is almost like the big driver of adoption, right? I mentioned the business owner who is, you know, rather than having to go and spend Friday night doing their payroll, right? It's having that automation happening and with a press of a button, getting it all done and feeling satisfied that they can now go and spend time with the family. Same thing with, you know, maybe a more mundane thing, you know, we all hate to file expenses. You know, having a solution which allows you to, in a very joined up way, when you're on a business trip, make those expenses, have them in real time being posted and, you know, within the policy and, you know, and you're basically done. It actually does, it does really have positive impact on how people go about, you know, doing their jobs and giving them ultimately more time or allowing them to achieve more. That's probably the big driver, actually, in terms of the initial driver for seeing solutions which delight customers, right? It's almost always the emotional experience first. And then you can analyze how much productivity it's giving you and you know how many less errors you're making and all the rest of it. But the real kind of impactful immediate driver is almost always emotional.
Yeah, absolutely. And I think that really resonates with how we experience in our consumer world as our business one, right?
I think this consumers bring their you know their bring their you know consumer into the workplace, right? They have expectations of how things ought to work, and they're often disappointed with business software. They're certainly disappointed with business banking. And so this is also an opportunity for us to you know really create value by giving them the same kind of experience and joined up solutions that we've come to encounter in the world as consumers.
Yeah, and I guess as well, you know, what's your view on the idea that maybe not all pain points are meant to be solved? And I ask because I think some of the research, you know, the customer research that we do here at KAE, we understand that not, you know, there are some pain points that if you solve for it, will have a bigger uplift in satisfaction, will have a bigger uplift in adoption, for example, and they might not even be the biggest, most prominent ones that you would think of that are kind of driving those outcomes. So what about you? What's your approach to identifying what are the pain points that are worth solving for, and are some just better left alone?
Well, you know, I mean, we don't try to guess that, right? This is why we support digital applications. They know their customers. They know what their customers care about. You know, they have granular data on usage. They basically sell the next module. Our job is not to preempt those. Our job is to, once they've figured out what really moves the needle for their customers, where it involves a financial step, to help them make that safe and to help it make them easy for them to actually deploy it. So I'm skirting around the question a little bit, but it really is part of the distribution model of embedded finance that we don't have to understand those questions. It's actually enabling others who are more in context of the customer to be able to find the right things to invest in solutions for.
Yeah, and delight, as you said earlier. Brilliant. All right then. Do you feel like there are any companies that are doing this really, really well at the moment that you would call out as a kind of an example that we can hold up and say they're sort of doing it really well? Are you allowed to say Weavr? It won't be some.
Well, we as the enabler. I mean, I am what I would say is that we talk to all the major accounting platforms, and what's interesting is that we find as a very kind of repetitive theme is that they have all done their experiments with embedded finance, and often they have built several partnerships. And one of the challenges they're finding is, okay, you have multiple partners, but now customers need to onboard multiple times with different financial partners. That's not great. So what we're seeing is that some companies are thinking holistically about this. How do they create the infrastructure so that the customer can onboard once and can then access multiple financial products? No one's really cracked this, but a number of really established platforms recognize the problem and are starting to solve for it. So again, it's one of those things which I think will be quite transformational when it happens. We also see examples of almost the inverse of embedded finance, where financial platforms, a good example would be Tide, for example, for small businesses, where instead of taking financial services into software, they have brought software into financial services. So that's maybe another sort of way to try and create this sort of cohesive, joined up, coherent set of capabilities for small businesses to get both their business processes done, but also their financial processes done in one place. I think what Tide have built as a customer experience is very coherent and very well joined up.
Brilliant.
But
Okay.
there's no one has completely solved this problem, and I think that's what makes the space exciting.
Yeah, absolutely, and a really good talking point. So looking ahead, then, I think we've talked a lot about sort of what's happening right now in the embedded finance and the embedded payments world, and some of the endeavors that key players are making to continuously make that experience all the more better for their customers. But what's coming down the line, do you think, in the world of embedded finance or payments that you think could be a disruptor or a game changer that those listening in today should sort of keep an eye out on?
Well, we've managed not to talk about AI since the start of the conversation, and I think it's time to bring it in.
Let's do that.
So AI has a lot of impact in financial service generally, but also in delivery of embedded finance. It has impact in terms of making the processes more efficient, more automated, using machine learning to get better outcomes. But I think the real game changer for me is how agentic AI will change the business software landscape, and that has huge implications for embedded finance. So if business software today is really about keeping the business data and helping businesses implement workflows on that data, agentic AI is also replacing a part of what the human person driving the software is doing, right? In terms of going and getting stuff done. And so with agentic AI, a good example is one company that we're talking to. They're not a customer yet, but they have an accounting system with an agent that handles all of the invoice, processing, classification, deciding when to pay them, basically deciding really where they source the money from, and so on. And that agent ultimately stops short when it comes to making the payment, because at least under European and UK legislation, you actually need a human in the loop to approve the payment, right? So strong customer authentication, in most cases, at least the default version of it, requires a human being to authenticate the transaction. Now, building embedded finance for agents is actually I think, both a powerful thing, but also a challenging one. Many financial, many kind of financial risk management solutions are all about keeping bots from accessing financial systems.
Mm.
In this case, agents are bots that are actually deployed by the customer, right? So we have to start going from keeping bots out to figuring out which are the benign bots, authorized bots, if you like, or agents, and
Differentiating between the two.
yeah, and the rogue ones, right, which we really want to keep out.
Mm.
So I think that's one of the really challenging implications for embedded finance. It's also exciting because we need to find solutions for these things, and as we find solutions, we create more value, and ultimately um, we become part of this big transition that is going to happen in how business software gets built and how businesses get run.
Fantastic. Well, we did go quite a long time without talking about AI, but it was worth it in the end because I know that that's a really interesting challenge that the industry needs to sink its teeth into. Anything else coming down the line that you'd kind of call out as a key consideration, and then we'll move through to the Q&A because I can see some coming through.
No, I think we've covered a lot of ground. We can certainly pick some questions.
Great. All right then, and I hope I can do these justice. And apologies if I'm squinting into the camera here to read them out. But the first one is a question or a comment, which is users are going to look for the best or the most efficient user experience. If traditional banks don't serve this as an infrastructure provider, then other FIs will step in and take share. Interested to know how Alex is seeing the larger legacy banks approaching this.
I genuinely think the legacy banks are behind for a reason, right? They don't get prizes for doing things right. They get a lot of stick for doing them wrong, and I think there's still a lot of experimentation that has to be done to get this right. Creating a seamless customer experience in financial services where, as a customer, you don't care whether you're suddenly looking at your business data and at the other moment you're looking at a transaction happening. It's part of, for you, it's just one part of the process. For banks, it matters a lot when you're moving from that screen to another. The whole context of data security, of consent, of basically avoiding the opportunities for fraud. Suddenly, there's a very big shift in operating environment, and yet for the customer, it has to appear seamless, as if it was a very natural transition from one to the other. That is a really hard problem to solve. I think many banks have got governance around trying to avoid a lot of the things that you will want to do in embedded finance, such as sharing of data, such as having a third party be a man in the middle between the bank's capability and the customer. And so I don't think this problem is going to be solved very quickly. I think what will happen is best practice is starting to emerge, and the most forward-looking banks will be investing in embedded finance programs. I don't think they will be generic. I think banks will pick their battles. They will pick a specific segment, a specific product. Maybe lending might be, business lending might be that, or commercial cards might be another one, where they would look to work with partners to deploy in this more risky way. But ultimately, if customers want it, banks will need to be where customers want to be. So that I acknowledge the problem. I'm not hopeful for a rush for this to be solved by the legacy banks, but I think eventually many of them will have to find a solution to be part of this expectation that customers increasingly will have.
All right. All right. Well, great question. Nicely answered. So thank you. Let's move to the next one then. How can regulation and compliance play a role in protecting users without stifling innovation?
Gosh, yes, this is tough. Regulators are always slightly behind the curve, right? They try to solve a problem that they have discovered in the market. And I mean, right now there's a big problem, for example, with preventing scams in especially for micro enterprises. They're in the scope, and what's happening is that that regulators create solutions for these challenges. Strong customer authentication was a good example. Now, when you come into embedded finance, you suddenly start to see that this regulation is starting to create very perverse situations where you want to automate something, and it's for the benefit of the customer that it's automated. For example, the software can do certain things for the customer, helping them automate, helping them do stuff so that they don't have to. But if the regulation forces the customer to step in and having to authenticate, then obviously that defeats the whole purpose. We found this situation with doing bulk payments, like in accounts payable. If the software is automating all of those payments, but every single payment to a supplier has to be authenticated by a human, there's no point automating. You might as well extract a file and upload it into your banking portal than have 200 approvals that you have to do in your software.
Yeah,
So
you've just created another friction point, right?
that's
You've
right.
created one for another.
That's right. So this is an unintended consequence of regulation, and I think regulators are often welcome these kind of this feedback from the market in terms of what is happening and the unintended consequence of regulation. We've seen exactly the same thing with APP fraud reimbursement in the UK, where again we've seen questions from regulators asking, did this program shut down because of the impact of APP fraud? And in some cases, the answer was yes. It was no longer viable to make it work, given the degree of control that you need and the standards of care that you need to basically be out of scope or limit the exposure from APP fraud. So unfortunately, there is no clear answer here. This is an arms race where regulators are always trying to prevent harm, and in doing so, the solutions they come up with sometimes actually preempt the good technologies, good sort of ideas from being practical.
And with my consumer hat on, I think sometimes from a protection perspective, friction's not always a bad thing, right? If you're making a purchase or you're going through with a very big financial decision, having that moment of friction, that moment to change your mind, is actually a mechanism that sometimes can be quite good for consumers when making important decisions. Would you agree with that? And maybe that's sort of another sort of sphere that the regulators consider.
Yes, look. I think these sort of these scams destroy lives, right? I mean, I don't make light of that at all. But the regulation designed to deal with that often has unintended consequences that really prevent good stuff from happening, and stuff that they were never designed to prevent. And so I think what I would like to see is that regulators recognize that, just like they recognize that electronic channels really brought a whole bunch of different tools and expectations, like electronic KYC, for example, that's now become accepted by most regulators, right? That can happen, or electronic consent. I think regulators will catch up and realize that certain ways of assuring integrity and consent need to be designed in such a way, or the regulation needs to be designed in such a way that they can also be done to the right standards within an embedded finance context. We are not there yet.
Yeah, absolutely. All right, so let's take us through to the last question. I think we've got time for just one more. This one's about friction. Where does friction tend to show up in poorly implemented embedded finance solutions? So those that have been implemented, where does it show up? Is it in the onboarding? Is it in the transparency, the trust, or is it something else that causes it?
It can
Or
show
all
up
of the above?
in, yes. Well, this is what I mentioned earlier, this kind of do act, right? All of them cause friction. If to give consent, you have to go out of the software and somehow log into your banking portal and give consent. That is friction. If to be onboarded, you cannot do it as part of the onboarding that you do when you're adopting a new software package. You start with that onboarding and then you're told, but now you've got to continue in your bank and open an account and then come back when you're ready. That creates friction. Now, the best solutions and the best infrastructure for embedded finance identifies these problems ahead of time and looks for solutions that do not compromise on the standards, but actually remove the points of friction. And it's a work in progress. You can't, in many cases, I said the legislation and the regulation was not designed for an embedded finance channel, and therefore you have to get very resourceful about how you meet the requirements of the legislation, while at the same time, removing the friction. The areas are around consent, around authentication, around onboarding, even monitoring of transactions. Basically, if a bank is doing the transaction monitoring and it's not seeing it in context of the software, sometimes there will be unintended consequences there, or unintended decisions that aren't right. If you had to see the context as a whole, you would allow the transaction to go through, but now you're questioning it because you don't have the full context. So those are the wrinkles, right? Those are also the opportunities for us to create better infrastructure to solve for embedded finance.
Brilliant, thank you. And I think that's a really good point to finish on. So thank you so much, Alex, for today's really insightful conversation. I know I really enjoyed it, and always learn a lot from speaking with you. So thank you for sharing your time and your knowledge with us all. And thank you to all of those who joined us today. The recording for this fireside chat will be available, so you can feel free to watch it again or share it with your colleagues. And if you would like to continue the conversation with either myself or with Alex, then do feel free to reach out. But apart from that, have a lovely day, everyone. Goodbye.